For over a decade, 1% has been the growth average for the South African economy. The country may be breaking out of that mold in 2025. The Bureau of Economic Research has upped its growth expectations for the country to 2.2% for next year. That's above projections from Treasury, the IMF, and the Reserve Bank. Shannon Bold, the senior economist for macroeconomic modelling and forecasting at the BR, joins us now with a greater perspective on the factors driving the group's positive outlook for growth. Thank you so much for your time this afternoon, Shannon.
No, thank you for having me.
All right, it does sound like optimism is what we're finally, I think, sensing when we speak of our economy. Keen to get thoughts on what might be driving that optimism.
Right, so I think we can't talk about next year's growth without considering the base from this year. So we started off on a very tough footing in the first quarter. The economy unexpectedly contracted in the first quarter. But that does create quite a low base. So relative to our April forecast, we did revise our growth for 2024 down to 1%. So that's the first thing that is actually supporting our upward revision for next year from 1.6% previously to 2.2%. But we're also seeing that a lot of the downside risks that were present have now also alleviated with the formation of the GNU. I think we're expecting a lot more optimism to come through, so improved sentiment should help support investment and consumption spending going into the second half of this year and following through into 2025. I think it's also going to allow other investment that's outside of renewable energy investment to also start resuming. And I also think that there was, especially now, if you look at our surveys, there was a lot of wait and see around the elections and a bit of uncertainty. And I think that pent-up demand should also start coming through towards the end of this year into next year. I do also just want to stress, though, that beyond 2025, our growth forecast is still below 2%. So for us to start being more confident about upward revising that medium-term growth trajectory, we have to see a lot more of the structural reforms taking hold for us to be able to confidently revise growth higher in the medium to long term.
I'm actually keen maybe to engage on some of that because, of course, we've seen the GNU come to be. I don't think anybody can really gauge its competence or even how well it's working at this time. We've also heard that Operation Vulindlela has been rather successful. And I'm wondering, which one possibly weighs more here? Shannon, is it a confidence issue that then weighs, that's based on the GNU, or is it actual reforms that emerge from Operation Vulindlela?
I think both play a very important role. So we actually did do some research around what would happen if the structural reforms that are contained in Operation Vulindlela, and specifically those in the network industry. So that doesn't just include electricity. I think there's still, although it's been very successful in its first phase, there's still a lot of work that needs to be done. That's around now the transmission lines in electricity, water infrastructure investment, and of course, the rails and ports issues so that we can still access markets globally. So the Operation Vulindlela will make it a business environment that's more able to work, but the confidence then also unleashes a lot more private sector investment and consumption spending. So I think you need both, but in our Operation Vulindlela scenario, we actually saw growth in the out years of the forecast. So for us, that would be towards 2029. Okay. If there's successful implementation, and that comes with a reduction in uncertainty, which is basically an improvement in sentiment, we could actually have growth of above 3% and be a three-handled economy again.
That would be fantastic, really. I'm also keen to understand how interest rates and the possibility of cuts later on this year play into our forecasts.
Certainly. So that is also one of the supporting factors for our consumption expenditure growth forecasts. I think the most supportive element of our consumption expenditure forecast comes from the durable spending side of goods. So as we see inflation coming solidly back to the middle of the target band and the Reserve Bank moving ahead with a cumulative 100 bips worth of interest rate cuts. So in our baseline forecast, we expect the first rate cut to come in the September MPC meeting, with another 25 bips in November, and then in the first half of next year, another 50 bips. This is in line with their own QPM model projections. So interest rate cuts, together with more real disposable income spending power, should also be supportive of consumption spending, but also specifically demand for durable goods.
And then, Shannon, I'm also keen to just touch on global issues here and how they can also, just lead to a more risky environment for the South African economy. Of course, we're trying to get our own domestic issues solved here, but we've got this election in the US in November, and that also stands to be a rather volatile one for us. That could dampen issues around inflation and even around trade. And I'm wondering if this is a material risk at this time, or if we're still maybe at a point where we're trying to see how the campaign that's running there plays out.
Sure, I think it's a risk in both directions, right? It's both an upside and a downside risk for growth, inflation, trade relations, all of the above. I do think, though, as we expect the Fed to start their interest rate cutting cycle, our rand is going to benefit from that, and that's going to be supportive of our inflation outlook. So that's separate from politics, of course. On the political front, there has been a lot of discussion around what would different presidencies mean for policy, specifically trade policy. We do know that for example, AGOA is a relatively small share of our total trade. So it should not be able to derail us completely, but other relations are, of course, also at risk. Added to that, any increase in geopolitical tensions could also impact oil prices, the rand, feeding through into inflation and going through the whole economy. But again, if there's a de-escalation in geopolitical tensions, then that would be positive for South Africa.
Right, but all sounds well for now. Very good to have these positive conversations around our economy. Shannon, thank you for taking us through this one this afternoon. That was Shannon Bold, Senior Economist for Macroeconomic Modeling and Forecasting at the BR.